Well, we're back from 4th of July, and stocks are not having a good day so far. After setting records on Wednesday, with Dow futures right into the close, reaching the 3,000 mark for the first time in history, and of course the S&P nearing 3,000 itself. I think it got up to like 29.92 or 29.95, right in there. It was in the 29.90s, so we're very close to 3,000, and there was a good chance that we could open the market on Friday in the 3,000s. That, however, did not happen. The market went up and kissed 3,000, and it came back down. And it did not come down for technical reasons. The market came down because of something that the algos perceived to be bad news for stocks. And what was that news, you could ask? It was actually a pretty great jobs report. The NonFarm Payroll report came out this Friday for the month of June, and it showed that there were about 224,000 new jobs created in the month of June, and they only were expecting about 160,000. So you would think, hey, this is a great jobs report. You're 60,000 jobs, more jobs than were expected. But that's not the case for the algos, because right now the algos, they have a little toggle switch on the algos. And there's the switch either goes to bad news is good news or bad news is bad news. And right now it's turned to bad news is good news, and that means that good news is bad news. Because now the 3-month average for the non-farm payroll report is about 170,000. Because we had an average month 3 months ago, or 2 months ago, we had a pretty bad month in the month of May, and now June was exceptionally good. So that averages out to pretty decent all around, and that's not what the stock market was looking for. The stock has been rallying, actually, the last couple weeks, strangely enough, on terrible news, terrible economic data coming out. And that's because they thought it was that all this bad economic data was increasing the likelihood that the Federal Reserve would cut interest rates in their July meeting. Now, of course, the Fed is very dovish. But they're also trying to maintain some credibility because the Fed, for a long time, has had this aura around them that they are magical wizards who know everything that's going on with the economy, and especially because of the Greenspan era. Greenspan was called the maestro. He was pulling the strings in the entire U.S. economy and making everything run smoothly. So people who are in the Fed and run the Fed have a lot of clout, and they need to maintain that by not looking like they are simply reacting to the stock market every day, which is exactly what they're doing in practice. So they're trying to look for ways so they don't look like that. So the hope was, because everyone really on Wall Street knows now that in order for stocks to keep going up, they just need more stimulus, because that's what has fueled the stock market bubble since the end of 2008. In 2008, without the Fed in quantitative easing, stocks would have continued to fall even further than they did. And of course, when they ended QE1, they knew that without QE2, stocks wouldn't go up anymore. And then when they ended QE2, they knew that without QE3, stocks would not go up anymore. And then after QE3, what did we end up with? We got tax cuts and and a new Republican president and all this optimism, and that helped fuel stocks. And then this year we've had all this trade talk optimism. So this has all been fluff. There's been no fundamentals really underlying the growth in the U.S. stock market, because the U.S. economy has been growing very slowly. But relatively speaking, the U.S. stock market has exploded. And so now here we finally get some decent news this year about the U.S. economy, saying, hey, you know what? The U.S., it's been looking like we're heading into a recession, but now that's not quite so certain. The U.S. may not be going into a recession. But then here we go. The market opens and stocks fall on news that the U.S. may not be entering a recession, because they need that fear to drive the Fed to cut rates. Because right now stocks are high and unemployment's low. The Fed has no reason to cut rates. The Fed's really their last sort of excuse to cut rates that they have left really is the fact that for some reason they want inflation to be 2%, and it's below 2% right now. So they could say, hey, we're below our inflation target, so we're going to cut rates and inject some more money in the economy and try and push up the cost of living. I think that it's absolutely disgusting that people target increasing the cost of living every year by 2%, because there's a lot of people in this country with fixed incomes or people who are making less money for whatever reason. And that just makes it more difficult for everyone on the bottom to get by every year. Back in the 19th century in the United States, prices fell every year. Especially after the Civil War with the Industrial Revolution in America, the price of goods fell every year because things were being made cheaper and better. And so even if you stayed the same, because the U.S. economy overall was doing so much better, your standard of living went up. It's the opposite these days, because the Fed tries to increase the cost of living every year through their artificial money printing. And so for some reason, they can take that sick, twisted rationale and use it as an excuse to cut rates. But other than that, I see no reason why the Fed would cut rates in July now, which, again, I think that the Fed is particularly dovish, so I think they're going to look for any excuse they have. So they may still do it, even if it's just a 25 basis point cut. But really, without the pretense, no matter how much the Fed wants to cut rates, I think they're in a tough spot, considering how much they care about their credibility, to cut without a decent excuse. Now, that excuse may come, however, if the stock market continues to sell off, because I think, I can't remember which bank, but one of the investment banks actually put out a pretty decent target range saying, hey, if it looks like the Fed's not going to cut rates and stocks start falling, here, depending on what range the stock market falls to, the S&P specifically, here's where we may actually see the odds of a rate cut go up. And I don't remember what their exact ranges were, but I'll tell you right now. If the S&P gets down back below, let's say 2,800, you'll see that 50 basis point rate cut. The Fed will do it. And the algos know that. The markets know that. That's why everybody's selling off today. They want to scare the Fed. This is a temper tantrum. They're saying to the Fed, wow, 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 we want a rate cut, so we're not going to buy stocks. In fact, we're going to sell. We're going to sell just a bit. We're going to sell just enough to turn up the heat in your kitchen. So that you'll get cooking and fry us up a couple of rate cuts. And that's all you're seeing today. So until the Fed comes out and massages the markets and tells them, oh no, don't worry, baby, we got that rate cut coming, well, then you're going to continue to see this temper tantrum. And of course, there's also the problem of the megaphone pattern, which again, I'm not a technician, I'm more focused on fundamentals, but there is one technical analyst that I like to follow named Sven Henrik on Twitter. You should look him up. And he's pointed out that really in the last few months, if you look at the S&P, we've got this broadening wedge in which you're seeing the market really move up and down in a broader and broader range. Every rally seems to be getting stronger, and then every sell-off is also stronger. And since we've just had a very strong rally in this, most recently, he's basically saying that the next sell-off, if this megaphone pattern continues, if this wedge continues to broaden, we're looking at the S&P in the 2,000 range. Well below 2,800. However, in order to trigger that kind of a sell-off that's that severe, I think that based on Mr. Henrik's trend lines, you're probably going to want to see a retest of the a test. Not a retest, hasn't happened yet, but a test of the S&P in the 3,000 to 3,050 range. And so that may be put off until after the Fed is pushed by the market into cutting rates, because I have to imagine that there's going to be you're going to have a pretty vertical rally after the market scares the Fed into cutting rates. Especially if you do indeed get that 50 basis point cut. So I'm going to keep an eye on that, and it'll be very interesting to see just how far the market pushes itself down and tries to rub the Fed's nose in it. And so while I'm monitoring this situation, I'd appreciate you if you click that subscribe button and especially the like button. And be aware that I do upload every day on a variety of topics, not just financial markets, but mostly financial markets and foreign policy. And I hope to see you back here in the next one.